Asset allocation is a crucial part of investing. It involves strategically dividing your investment portfolio among different asset classes to balance risk and reward. Imagine a pie chart of your investments. This visual representation helps you see how your money is distributed. Each slice represents a different asset class, such as stocks, bonds, or real estate. These could be stocks, bonds, or real estate. Each asset class has its own risk and return characteristics. Asset allocation is about dividing your money among these slices. Why is this important? It helps manage risk. Different assets behave differently under various market conditions. When one asset class goes down, another might go up. This counterbalance can protect your portfolio from significant losses. By spreading your investments, you reduce the chance of big losses. Diversification is key to a resilient portfolio. Asset allocation makes your portfolio stronger and more adaptable to market changes. It's like having a safety net for your money. This safety net can cushion the impact of market downturns. This can lead to more consistent returns over time. A well-allocated portfolio can weather market volatility better. Think of it like this: you wouldn't put all your eggs in one basket. Diversification spreads risk. The same goes for your money. Diversifying your investments can protect you from losing everything if one investment fails. Asset allocation is about not putting all your investment hopes in one place. It's a strategy to manage risk and optimize returns. It's about spreading your risk and increasing your chances of success. A well-diversified portfolio is a cornerstone of sound investing. Your asset allocation strategy should be tailored to you. It's not one size fits all. Everyone's financial situation and goals are unique, and so should be their investment approach. There are a few things to consider when creating yours. These factors will help you build a strategy that aligns with your personal financial situation and future aspirations. First, think about your goals. What do you want to achieve with your investments? What are you saving for? Are you planning for retirement, buying a house, or perhaps funding your child's education? Is it retirement, a house, or something else? Clearly defining your goals will guide your investment choices. Your goals will impact how you allocate your assets. Different goals may require different investment strategies. Next, consider your risk tolerance. This is crucial in determining the types of investments that are suitable for you. How much risk are you comfortable with? Are you willing to take on high-risk investments for potentially higher returns, or do you prefer safer, more stable options? If you're younger, you might be okay with more risk. Younger investors often have the advantage of time to recover from potential losses. If you're closer to retirement, you might want less. As you approach your financial goals, preserving your capital becomes more important. Finally, think about your time horizon. This is the period you expect to hold your investments before you need to access the funds. How long do you have to invest? The length of your investment horizon can influence your risk tolerance and asset allocation. Longer time horizons usually allow for more risk. With more time, you can ride out market fluctuations and potentially achieve higher returns. Remember, your asset allocation strategy is personal. It should reflect your unique financial situation, goals, and risk tolerance. What works for someone else might not work for you. Tailor your strategy to fit your own needs and circumstances. Take the time to understand your needs and goals. A well-thought-out asset allocation strategy can help you achieve your financial objectives. Allocation ratios are the percentages of your money in each asset class. These ratios help you diversify your investments and manage risk effectively. For example, you might have 60% in stocks and 40% in bonds. This is a common allocation for those seeking a balanced approach. Finding the right ratios for you is key. It involves understanding your financial goals, risk tolerance, and investment horizon. Your risk tolerance plays a big role. If you can handle more risk, you might allocate more to stocks, which can offer higher returns but come with greater volatility. A higher risk tolerance might mean more stocks. Stocks have the potential for significant growth, but they can also experience sharp declines. A lower risk tolerance might mean more bonds. Bonds are generally safer and provide steady income, but their returns are usually lower compared to stocks. Your time horizon also matters. The length of time you plan to invest can influence your allocation decisions. Longer time horizons can handle more risk. If you have many years before you need the money, you can afford to ride out market fluctuations. This could mean a higher allocation to stocks. Over time, stocks have historically outperformed other asset classes. Shorter time horizons might need a more conservative approach. If you need the money soon, you might prefer safer investments like bonds. Remember, there's no magic formula. The right allocation for you depends on your unique situation and goals. Finding your optimal allocation ratios takes time and careful consideration. It's important to review and adjust your portfolio regularly. Don't be afraid to adjust them as your needs and the market change. Flexibility and regular reviews can help you stay on track to meet your financial goals. Section 4. Navigating volatile markets. Markets go up and down, that's their nature. But asset allocation can help you stay calm during the downswings. Diversification is key. When one asset class is performing poorly, another might be doing well. This can help offset potential losses. Review your asset allocation regularly. Make sure it still aligns with your goals and risk tolerance. Don't panic and sell everything when the market drops. This is often the worst thing to do. Your diversified portfolio is designed to weather these storms. Stay the course and remember your long-term goals. Section 5. Asset allocation and stable returns. Asset allocation is not about getting rich quickly. It's about building wealth steadily over time. By spreading your investments, you're less exposed to the ups and downs of any single asset. This can lead to more consistent returns in the long run. Remember, investing is a marathon, not a sprint. Asset allocation is your strategy for running a smart and steady race. Don't get distracted by the noise of the market. Focus on your long-term goals and trust in your asset allocation strategy. Section 6. The power of diversification. We've talked a lot about diversification, but what does it really mean? Imagine you only invested in one company. If that company fails, you lose everything, but if you invest in 10 different companies, the risk is spread out. Diversification applies to asset classes too. Don't put all your money in stocks or bonds. Spread it out across different assets to reduce risk. Remember, diversification is your friend. It's the key to protecting your investments and achieving your financial goals. To Section 7, seek expert guidance. Asset allocation can feel complicated, but you don't have to do it alone. Financial advisors can help you create a personalized strategy. They can also answer your questions and provide guidance along the way. Don't be afraid to ask for help. It's your money and your future. You deserve to have an expert in your corner. Remember, knowledge is power. The more you know about asset allocation, the better equipped you'll be to make smart investment decisions.